Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host. I'm Sandy, your guest host from Keller Williams Legacies, here to provide you with insights sourced from reputable news outlets to help you stay informed.
Steve Hemoen here. This is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode. All right, Sandy, let's jump right into the big news. Both the U.S., Federal Reserve, and the Bank of Canada have cut their interest rates by 25 basis points. This is quite a significant move, wouldn't you say?
Absolutely, Steve. The Fed's rate now sits in the range of 4.00 to 4.25%, while the Bank of Canada's rate has come down to 2.50%. This is all happening against a backdrop of weakening labor markets in both countries.
Right. In the United States, the rate cut follows a weak August job report and some signs of inflation ticking up. TD chief economist Beata Caranci has pointed out that even though inflation is hotter than the Fed might like, the softer economic conditions justified the cut.
And here in Canada, the central bank made its decision after consecutive job reports showing job losses. Our unemployment rate climbed to 7.1% in August, and although inflation has eased from its pandemic peak, it did rise slightly in August to 1.9%.
It's interesting to note that while inflation is a concern, the Bank of Canada seems to be more focused on the economic slowdown. Maria Solovieva from TD Economics highlighted that core inflation remains near 3%, which is above the bank's target of 2%.
Exactly, Steve. The cuts are intended to help balance the risks between inflation and economic weakness. For Canadians with variable rate mortgages, this could mean more of their payments will go towards the principal rather than interest.
Yes, and for those with fixed-rate mortgages, the impact won't be immediate, since these rates are usually tied to bond yields. But in the longer term, we might see some shifts if the central bank continues to cut rates.
It seems both central banks are trying to strike a balance. The Fed, for instance, is dealing with the possibility of future inflation spikes due to tariffs, and TD Economics predicts they might lower rates 2 more times this year.
Meanwhile, the Bank of Canada is also navigating through the effects of tariffs, which are affecting trade and business investments. TD Economics expects one more rate cut from the Bank of Canada by the end of the year, potentially bringing the rate down to 2.25%.
All right, let's move on to our next topic, Steve. The Bank of Canada has decided to hold its overnight lending rate steady at 2.75%. This decision comes after a period of rate cuts, and it seems like some professionals in the real estate industry were hoping for more reductions.
That's right, Sandy. While the Bank of Canada has cut rates by 225 basis points over the past year, some industry leaders were left unsatisfied. They believe that a further cut could have helped boost confidence in the market. Christopher Wine, the chief operating officer of Equiton, mentioned that consumer confidence is quite low and that another rate cut might have helped improve it.
It seems like the central bank is being cautious, especially with the current global trade tensions. U.S. President Donald Trump's recent threats to increase tariffs on steel and aluminum are certainly adding to the economic uncertainty. Canada, being a major supplier of these metals to the United States, could face economic repercussions.
Exactly. And that uncertainty is reflected in the Bank of Canada's decision. They mentioned that they're closely monitoring the situation, especially since tariffs can have inflationary effects. The bank has to balance the potential upward pressure on inflation due to tariffs with the downward pressure from a softer economy.
And speaking of inflation, the Bank of Canada noted some unexpected firmness in recent inflation data. While they're keeping an eye on the situation, they did leave the door open for potential rate cuts later this year, depending on how things unfold.
Money markets and economists are still expecting at least 2 more rate cuts by the end of the year. Marcus and Millichap pointed out that further cuts could benefit commercial real estate investors by lowering borrowing costs. However, they also noted the potential for rising bond yields due to the tariffs and government deficits, which could offset some benefits.
That's an interesting point. With the ongoing uncertainty, the real estate market seems to be in a bit of a holding pattern. Phil Soper from Royal LePage highlighted that sales activity is stalled in some of the country's most expensive markets, with buyers remaining cautious.
And it's not just the buyers. Developers like Jordan Kemp from Graywood Developments are also feeling the pinch. He mentioned that while a rate cut could help, the overall uncertainty is affecting where people want to invest their money. It's a challenging environment for sure.
It is indeed, Steve. And with the next decision from the Bank of Canada expected on July 30th, it'll be interesting to see how these factors play out and whether we'll see any changes in the lending rates.
Sandy, let's talk about the recent data from the Toronto Regional Real Estate Board. It's been quite a ride for Toronto area home prices, which have now fallen for the ninth consecutive month. We're looking at a 21% drop since the peak in 2022. This is the largest downturn since the 1990s. How do you see this affecting the market?
It's definitely a significant shift, Steve. For prospective homebuyers, this downturn could be seen as an opportunity. Jason Mercer, Chief Information Officer at TRREB, mentioned that buyers now have a lot more negotiating power, which generally leads to lower prices.
Right. And with sales down 9.5% compared to last October and new listings up by 2.7%, it seems the market is shifting towards buyers. The average property price is now around $1,054,000, down about 7% from last October.
Yes, and it's not just condos that are seeing a drop. Detached home prices have fallen approximately 25% to $1,355,506, and semi-detached homes are down 24% to $1,033,770 since February 2022. Even condos have taken a hit, down about 18% to $660,208.
These numbers show that the market is definitely cooling off. But it's important to note that while prices are down, this doesn't necessarily mean the market is crashing. Jason Mercer pointed out that prices are responding to a lack of affordability, and as we move into 2026, he expects more households might re-enter the market if the economy stabilizes.
That's a good point, Steve. The Bank of Canada's recent interest rate cut to 2.25% could also play a role in boosting sales. Many experts are hopeful that this might spur more activity in the market.
And as Jason Mercer mentioned, we're perhaps nearing the bottom of the price declines. With the interest rate cuts and the price declines we've seen this year, the average mortgage payment is moving closer to the average household income. That could be the inflection point for a pickup in sales.
Exactly, Steve. It's a challenging time for sellers, but potentially a window of opportunity for buyers. We'll have to keep an eye on how these factors influence the market as we head into next year. The Greater Toronto Area's real estate market is undergoing a notable shift, Steve. In October, home sales experienced a decline compared to last year, with a 9.5% drop, while a modest rise in new listings is giving buyers more options and negotiating power.
That's right, Sandy. According to the Toronto Regional Real Estate Board, or TAR-REB, there were 6,138 sales recorded through their MLS system, and 16,069 new listings came to the market. The average selling price fell to $1,054,372, which is 7.2% lower than a year earlier. This shift is creating a more balanced market, wouldn't you say?
Absolutely, Steve. TAR-REB President Alekia Berry-Sproul pointed out that buyers who are confident in their employment situation and ability to make mortgage payments are benefiting from these more affordable conditions. However, not everyone is jumping in just yet due to lingering economic uncertainty.
And it's not just about the prices. The seasonally adjusted figures showed a slight monthly slowdown in both sales and listings compared with September. While the benchmark price held steady, the average price edged down, which indicates that the market is still somewhat cautious.
Jason Mercer, TAR-REB's Chief Information Officer, highlighted that easing mortgage rates are playing a significant role in improving affordability. Lower borrowing costs, combined with declining selling prices, mean more buyers can now afford homes that meet their needs.
Indeed, Sandy. And once there's more certainty regarding the economic front, including trade relations with the United States and China, we could see an uptick in home sales. It's a matter of when, not if, these factors stabilize.
Sandy MacKay, TRREB's CEO, emphasized the importance of long-term supply solutions. He mentioned that housing is crucial economic infrastructure, and innovation alongside private capital is necessary to accelerate new construction across all housing types.
He also touched on the role of government in this, suggesting that modernizing tax rules, reducing buyer costs, and ending exclusionary zoning could significantly help in rebuilding confidence and creating jobs. It's a collaborative effort that's needed to deliver the homes Ontarians require.
Steve, let's dive into the recent report from the Canada Mortgage and Housing Corporation. It seems Canada might need to double its housing construction to regain affordability, a pretty ambitious goal. What are your thoughts on this?
It's certainly a tall order, Sandy. The Canada Mortgage and Housing Corporation estimates that we need between 430,000 and 480,000 units built annually over the next decade to get back to 2019 affordability levels. That's double the current pace. While it sounds challenging, the Crown Corporation believes it's achievable with the right systemic changes.
Doubling the pace of housing construction means more than just increasing the number of units. It involves modernizing the workforce, attracting more private investment, reducing regulation and delays, and lowering development costs. Aled Ab Yorworth from the Canada Mortgage and Housing Corporation emphasized the need for innovation in construction technology and improved labor productivity.
Exactly, Sandy. The focus isn't just on quantity, but also on efficiency and innovation. The report highlights the importance of addressing the housing supply gaps across Canada, ensuring policymakers and the private sector understand the scale of the challenge. It's about systemic changes that can double the pace of home building.
The Canadian Real Estate Association reported that the benchmark price index for all housing was just under $700,000 last month, a significant drop from the 2022 peak. However, it's still higher than the 2019 benchmark of just under $550,000. This gap indicates the extent of the affordability issue we're facing.
And it's not just a national issue, Sandy. The report points out that Toronto will need a 70% increase in home building over the next decade. Despite some progress in rental construction, the region lacks homeownership options that align with local incomes. Vancouver and Montreal are also facing significant housing gaps, with Montreal having the largest among the major metropolitan areas.
Prime Minister Mark Carney has set a mandate to build up to 500,000 housing units annually. However, Toronto Dominion Bank has expressed skepticism about whether the governing Liberal Party can meet these targets. The bank suggests that achieving even 400,000 units would require an unprecedented boost in productivity, essentially a revolution in how housing is developed.
The government's measures, like cutting the goods and services tax on new homes and lowering development charges, are steps in the right direction. But as the TD report suggests, these might not be enough to close the gap between current completions and targets. It's going to require more than just policy changes. It needs a complete overhaul in productivity and construction methods.
Absolutely, Steve. It's a complex issue that requires collaboration between the government, private sector, and the construction industry. As we move forward, it'll be crucial to monitor how these efforts unfold and whether Canada can indeed ramp up its housing construction to meet the demands of affordability. Steve, let's dive into some exciting news from the financial sector. Questrade Financial Group has received approval from the Office of the Superintendent of Financial Institutions to launch Questbank, a full-fledged Canadian bank. This is a significant milestone for Questrade as they transition from a discount brokerage to a comprehensive financial institution.
That's right, Sandy. This move allows Questrade to operate as a Schedule I bank, placing it in the same category as the country's largest lenders. It's an impressive leap for a company that started as a fintech disruptor. Questrade's CEO, Edward Kolodenko, described this development as a monumental step towards bringing much-needed competition to the Canadian banking landscape.
It's a remarkable journey for Questrade, Steve. They applied for this banking license back in 2019, and after 6 years, they've finally achieved it. The transition from a fintech platform to a regulated bank is no small feat. They've significantly increased their client assets from $9 billion at the time of their application to about $85 billion today.
Absolutely, Sandy. And with the launch of Questbank, they're planning to roll out their first products and services in the first half of 2026. While details are still under wraps, there's speculation about a potential re-entry into the mortgage market. This could shake things up quite a bit, especially if they leverage digital efficiency with balance sheet lending.
That would certainly be interesting, Steve. Having their own bank gives Questrade more control over funding costs and the ability to originate loans directly. This positions them to compete more aggressively in the prime mortgage space, especially against fintech peers who rely on partnerships with existing banks.
And the timing couldn't be better, Sandy. With federal plans for open banking and real-time payments on the horizon, newcomers like Questrade are well positioned to modernize how Canadians bank and borrow. It's an exciting time for the industry, with other challengers like Coho Financial and Banco Santander Canada also in the mix.
As Edward Kolodenko mentioned to the Globe and Mail, Questrade wants to be inside the tent, offering Canadians a regulated, trusted alternative to the big six banks. This move could not only intensify competition, but also provide more options for consumers looking for innovative banking solutions.
Definitely, Sandy. It's going to be fascinating to watch how Questbank's entry into the market unfolds. The potential impact on the mortgage sector could be significant, especially if they decide to offer competitive mortgage products.
Well, that's all the time we have for today's episode. It's been a pleasure discussing these developments with you, Steve. There's certainly a lot to look forward to in the coming months.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time, and stay informed with the latest industry insights.